Welcome everyone in today's video, and as you can see on my screen I am covering equity valuation concepts and basic tools, and I've divided this topic into two parts. So in this video, part 1, I will help you build your understanding around valuation concepts, and we will cover valuation overview, valuation methodologies and application of valuation methodologies. And in the second video, in the second part, whatever we will understand in this video, we are going to apply in a form of case study where we will, from scratch using Excel, we will build a model and value a fictitious company. So let's begin with valuation overview. Okay, first let's go through what the slide is saying. So what is valuation? Valuation is the analytical process of determining the current or projected worth of an asset or a company. And what do valuation tell you? A valuation can be useful when trying to determine the fair value of a security, which is determined by what a buyer is willing to pay a seller, assuming both parties enter the transaction willingly. So just to make it clear to you, here is the list of top 5 M&A deals in 2022. So let's say this is quite popular. Elon Musk to acquire tech giant Twitter for 44 billion. It's around the news and a lot of drama going on around this deal, but we're not going to get into it. But let's say Elon Musk is interested buying Twitter for 44 billion. Now the question is how he has arrived to this 44 billion, or anyone who is buying a company, how they know that what is the worth of that company or how much to pay to acquire that business. So that is where valuation comes into the picture. So through valuation, we try to determine the value of a company, a true value of a company, and this is one scope of valuation. The other scope of valuation could be for tax purpose, for financial reporting purpose, and so on. So let's jump to valuation methodology. So you know what is valuation and where to use valuation. Now, how to value a company is what we are going to understand here. So basically, there are three approaches to value a business. First is the discounted cash flow. Second is the relative valuation, and third is the asset-based approach. So we are going to go through each of the approach one by one. So first, let's talk about discounted cash flow approach. A DCF analysis attempts to figure out the value of a company today based on projections of how much money it will generate in the future. Okay, let's try to understand this definition through taking a real life example. Now, let's say if you're buying a mobile, how you decide the worth of your mobile, maybe on the basis of its processor, camera, built-in quality, etc., etc. But what about the financial asset? In financial asset, you put your money, you buy that investment, and you expect return in the future. So take example of any asset. So let's say if you are buying a bond, if you're investing in fixed deposit, then what you expect is the interest. Let's say if the maturity of the FD is 10 years, and you have applied to get the interest yearly, then you will get yearly interest for 10 years, and at the end of 10 year you will get the maturity amount. So these are your cash flows that you're going to receive in the future if you invest in bond or fixed deposit. Let's say if you buy a property and you're planning to sell that property in 10 years. So what you're going to receive is you're going to receive rent for 10 years, and then at the end of 10 years when you're going to sell the properties, you will realize the value of the property. So let's say if you're investing in share of a company which pays dividend, and you're planning to again sell that share in 10 years. So for 10 years, what you're going to receive is the dividend every year, and at the end of 10 year, when you're going to sell that share, whatever the price of that share at that time, you will realize the value. Okay, now let's move ahead. The DCF analysis finds the present value of expected future cash flow using a discount rate. The purpose of DCF analysis is to estimate the money an investor would receive from an investment adjusted for time value of money. The time value of money assumes that a dollar today is worth more than a dollar tomorrow. So the value of $10 10-year back is not same as the value of $10 today. Or for example, something I could buy in $10 10-year back, to buy the same thing, I may have to pay $50 today. And to incorporate this, we apply a discount. So the two component of DCF are cash flow and discount rate. So So your cash flow is the return on investment in a form of interest, in a form of rent, in a form of dividend, asset liquidation, and the discount rate is the discount that we are going to apply, assuming that what we are going to get in future will not have the same value as of today. Now, how to apply discount on the future cash flow to calculate its present value? Pay attention to this. So future value is equal to present value multiplied by 1 plus interest rate. So in an example of fixed deposit, let's say you invested 1 million today and you are going to get 10% interest annually. So at the end of year one, what is the value of your asset? So for your value of asset is 1 million plus 100,000 interest at the end of 1 year. So 1.1 million at the end of year one. Now, let's say if you have to calculate the present value. So if you rearrange this formula, your present value is equal to future value divided by 1 plus interest rate, which is the 10%. And if you do that, you will get to 1 million. Okay, now since we are focusing on equity valuation, so in terms of cash flow to discount, we could have dividend, free cash flow to equity, free cash flow to firm. If a company pays regular dividend, then dividend can be used as a benchmark. If not, then you can also use free cash flow to equity and free cash flow to firm. Free cash flow to equity is the free cash flow belongs to equity shareholder, whereas the free cash flow to firm belongs to all the providers of the fund, namely debt holders, preferred shareholders, and equity. Now, in terms of discount rate, you have cost of equity and cost of capital. So when you use free cash flow to equity, you arrive at the equity value of the firm. Whereas when you use the free cash flow to firm, you arrive at the value of the firm. When you're valuing the firm, you will use the cost of capital. When you're valuing the equity, you will use the cost of equity. Okay, let's move ahead and build the understanding further. So cash flow to discount. So dividend discount model. The DDM model is based on the theory that value of a company is the present value of the sum of all future dividend payments. So in the case where the company pays dividend, we can use the dividend discount model. FCFE model. A free cash flow to equity is the amount of cash a business generate that is available to be potentially distributed to the shareholders. Shareholders, I'm referring to equity shareholders. Now, the FCFE formula is your net income plus depreciation and amortization plus changes in working capital, capex, and net borrowing. Now, you must be wondering why we are calculating this FCFE when we can just use the net income, because net income is what a equity holder look forward to. uh, it is correct, but the problem with net profit is that the net profit is not really the cash that a business has. Why? Because net profit is on the basis of accrual accounting. You have booked the revenue, but there is no cash inflow. You have booked the expenses, but there is no cash outflow. And there are also a few non-cash items such as depreciation, amortization, provisions. So that is why the net income is not really a benchmark which reflects the cash position of a business. There is also a debate that why the EBITDA can't be taken as a proxy of cash position, because EBITDA doesn't include the non-cash items such as depreciation and amortization. But what about the working capital, the working capital requirement? What about the capital expenditure? Because the capital expenditure goes through cash outflow from investing activity, and only the depreciation components comes into the P&L. That is why to deal with all these problems, we come with FCFE formula, where what we do is we start with net income, we add the non-cash items, which is depreciation and amortization, we incorporate the changes in working capital, we add the capex, and we also add net borrowing, because at the end of the day, whatever cash is available in the business belongs to equity shareholders after paying the principal and interest component to the debt holders. Now, let's say if you're arriving at the firm value of the business, then we will use the FCFF model. Now, the FCFF formula is your net income plus depreciation and amortization, similar to FCFE formula, plus interest. Now, here we are adding interest because if you look from the perspective of debt holders, the return for a debt holder is the interest. Now, since we are valuing the debt holder as well, we will include the interest component, multiply by 1 minus tax rate, because the interest is tax deductible. That's why we will do this adjustment, plus changes in working capital and capex. So that is how you will arrive at the FCF. Now, in terms of discount rate, so we discussed that cost of equity is used to value the equity portion, and cost of capital used to value the firm, which includes the equity plus that portion. Now to calculate the cost of equity, there are a lot of model available such as bond yield plus risk premium, Carhart 4-factor model, Farmer French 3-factor model. But the most famous model, which is widely used by valuation analysts, is the CAPM model, which is capital asset pricing model. Now the formula to calculate the cost of equity based on CAPM model is the risk-free rate plus the beta multiply by expected market return minus risk-free rate. Okay, let's understand the component of CAPM model. So first is the risk-free rate. So the risk-free rate of return is a return that you get because you're not spending money today and you are waiting to spend it, let's say 5 years, 10 years down the line. And also there's a risk of inflation, and because of inflation, the worth of your money today will not be as same 10 years, 5 years down the line. To compensate you from that risk, you should get risk-free return. The second component is the beta. Now, when we talk about the valuation of a company, every company will come under an industry, and every industry has different risk. Now, if you're comparing a tech industry with a pharma industry, you know that the tech industry is more risky than a pharma industry because the tech industry evolve over time, whereas the pharma industry, even if there's a recession, you know that the people would not stop taking medicines. Now, let's say how you build that risk into your return, that is through a beta. So that's how this beta take cares of the risk related to the industry. And this formula over here basically take cares of the risk which is related to the equity market. This expected market return is the return from the market. So let's say if you are based in India, then what is the return from the Nifty? Because Nifty is the benchmark of performance of Indian equity market. Let's say in case of US. Now let's say in the case of US, what is the return from S&P 500? So that is the market return. Now this market return already incorporate the risk-free rate, and since we are adding the risk-free rate over here, that is why to avoid the double counting, we are deducting the risk-free rate from here. And that is how we will arrive at the required or rate of return for a company. In terms of cost of debt is easy because cost of debt is nothing but the interest rate on the loan. A company's cost of debt is the effective interest rate a company pays on its debt obligations, including bond, mortgage, and any other form of debt the company may have. Now to calculate the cost of capital, we will use the WACC formula. So WACC stands for weighted average cost of capital. Okay, the first component is the cost of equity multiplied by weightage of equity. Now the cost of equity will come from the CAPM model, and what is the proportion of equity in the total capital. So let's say there's a company who has funded their business from 50% equity and 50% debt. So this 50% multiplied by the cost of equity plus the second component is, so this is the portion of equity which is 50% in our example. The cost of debt multiplied by 1 minus tax rate. So again, we are doing this tax adjustment because we know that the interest is tax deductible. So that is how we'll arrive at the WACC formula. Okay, now in terms of types of DCF model, we have one stage model, two stage model, and H model. So which model to utilize is basically dependent on the growth pattern of a company. Now let's say if you are valuing a very mature company which has a very stable growth pattern in the past and a very predictable future pattern in the future, then you can use one stage model. So let's say if you're valuing a startup company, then you can use a two-stage model. So in the first stage, you will have the high growth from the high growth phase. And then when the startup will reach to its maturity level, you can have that maturity stage as a second phase. This Now this H model is just like two-stage model. You can say it's a better version of it, because what H model suggests is that when a company switches from high growth to maturity growth, the reduction is linear. You can Google the formula for the H model. I'm not covering here. Okay, now moving forward, the relative valuation approach. So when we started, we discussed the DCF, and now we are discussing the relative valuation approach. So what is relative valuation approach? A relative valuation model is a business valuation model that compares a company's value to that of its competitors or industry peers to assess the firm's financial worth. Now, let's say you are running a tech business and you are interested in knowing your worth. So what you could do is you can look for the companies, the similar companies operating within the tech industry. Okay, let's try to understand this through an example. So the subject company, which is our company, has a EPS of 10. So EPS stands for earning per share. Now the formula for earning per share is the total earning divided by number of shares. Now why we are calculating EPS? Because It's not necessary the earning that we are making is similar to a company which is listed in the market. It could have 10 times, 20 times or more earning than what we are making. To make it to make it comparable, what we do is we calculate the earning per share. So it has a EPS of 10. The industry has an average PE ratio of 10. So industry in our example is a tech industry. So an average P ratio in tech industry is 10 and our EPS is 10. So what would be the price of our company? So that would be nothing but 10 multiplied by 10, which is 100. So 100 could be a price of our share. Okay, now let's go through what are the types of relative valuation models available. So we have price divided by earning per share, which we saw in this example. Price divided by book value per share. So book value is the value on the basis of what is there on the balance sheet, which is nothing but your total asset minus total liability, which gives you the equity value. So that is that value, and to calculate per share, what you need to do is your total book value divided by total number of shares. Then you have price to sales, price to cash flow, price to FCFE, EV to EBITDA, and EV to FCFF. So EV is your enterprise value. So when we talk about price, the price is the value that belongs to equity shareholders. But when we come to enterprise value is basically the value of equity plus value of debt and then adjusting the cash and cash equivalent, and then you compare with EBITDA and FCFF. So when you use the price multiple, you arrive at the equity value, and when you use the EV multiple, you arrive at the enterprise value. Okay, let's move ahead. Now, the third approach is the asset-based approach. It's a very simple approach. To calculate this, what you need to do is you have to deduct the total liabilities from the total assets, and then you will arrive at the value of equity. And this asset-based approach is most appropriate for business with tangible and liquid assets. Now, let's move to application of valuation methodologies. So whatever we discussed so far, how you apply those valuation methodology, we are going to discuss over here. Now let's talk about the fundamental choices for DCF valuation. Should you discount cash flow to equity or cash flow to firm? So use equity valuation for firms which have stable leverage, whether high or not, and equity stock is being valued. So this is what we discuss. If you are valuing the equity, then use the cash flow to equity. And if you're valuing the enterprise value, then use cash flow to firm. And also if a company does not have stable leverage, so you should use FCFF. So leverage means, let's say right now you have 50% debt and 50% equity. And in the future that 50% could turn out to be 70% equity and 30% debt, 80% equity, 20% debt. So if the leverage is changing, then you can use FCFF instead of FCFE. So use firm valuation for firms which have high leverage and expected to lower the leverage over time, because debt payment do not have to be factored in. The discount rate cost of capital does not change dramatically over time. For firms for which you have partial information on leverage, interest expense are missing, and all the cases where you are more interested in valuing the firm than the equity. Now, dividend discount model or FCFE. So use the dividend discount model which pays dividend, and for firm where FCFE are difficult to estimate, for example, banks and financial services company. Use the FCFE model for firms which pay dividend which are significantly higher or lower than free cash flow to equity. Now question is, what is significant? As a thumb of rule, if dividend are less than 75% of FCFE or dividend are greater than FCFE. Because see, at the end of the day, you can only pay what you generate. Now let's say if a company is paying regular dividend and suddenly it stop paying dividend, then it is a bad signal in the market. And to avoid that, what company do is company take loans and also fund their business just to pay dividend, just to avoid the circumstances. But that is not fundamental to company. That is why it is important to understand the relationship of your free cash flow and your dividend. And firms where dividend are not available, for let's say if a company does not pay dividend, then anyways you can't use the dividend model and you have to use FCFE model. Now, which cash flow to discount? So I think we discussed that cash flow to equity, we use cost of equity, cash flow to firm, we use cost of capital. What is the right growth pattern? I think we discussed this one stage, two stage, stable stage models. Now let's say what this slide says. So use the growth model only if cash flow are positive. Use the stable growth model if the firm is growing at a rate which is below or close within 1 to 2% to the growth rate of economy. So basically you can use the stable growth model for mature companies. Use this two-stage model if the firm is growing at a moderate rate within 8% of the stable growth rate. So you can use this model for the companies which can be classified as mid-cap companies, and use the three-stage growth model if the firm is growing at a higher rate, more than 8% higher than the stable growth rate. So this you can use for the companies which can be classified under small cap companies, or you can even use for startups. Now let's understand the fundamental choices for relative valuation. So price to earning per share, you can use most of the industries which are profitable. Price to book value per share, you can use for the companies with liquid assets and liabilities like bank and NBFCs. Price to sales when earning are negative. So it is obvious if the earnings are negative, then you can't use price to earning per share and you have to rely on price to sales. Price to cash flow, alternate to price to earning per share. But the thing is, it avoids non-cash items. EV to EBITDA for heavy industries, for the industries which have a lot of capital expenditure and accordingly a lot of depreciation in their books, you can use, for those companies you can use EV to EBITDA. Okay, so this is the end of the video and I've tried to cover the critical concept around the valuation. If there's something that you don't understand, or maybe I have covered it on a very high level, you can post your questions on the comment and I will get back to you. So in the next video, whatever we have discussed so far, we are going to implement it, building a model. So I hope you had a great learning session today and I see you the next time. Thank you.